So Jean, I'll start off with you because you were the first private equity investor, of course.
No.
Have you got the names wrong?
Sorry, Ron from Sanchar.
Yes, okay. Ron, I'll start off with you. Sorry about that. But what are your thoughts? You've been the first private equity investor in the company. I mean, how long have you been committed to the company for?
As a bank, we've been around export trading groups for over 6 years. As a private equity firm, we've been following the company for 4 years. We made our investment earlier this year in January, but I've been personally around the company for about 4 years, and as Standard Chartered, we're quite committed to the company for quite a long period of time.
And over the period of time that you have, of course, been committed, what are your thoughts on the performance from initial investment to now?
The company has continued to perform very well. For the fiscal year ended March 2012 this year, they delivered revenue of about $900 million, and they're on target to double that. So in terms of performance, the business has done extremely well. We continue to be very committed to our investment, and we think there's significant growth coming ahead.
Mm-hmm. And of course, 2 new players on board when it comes to investing $210 million. You've got the Remgro Pembani Infrastructure Fund, and then of course you've also got the Carlyle Group coming on board. What does this mean for helping you accelerate your growth?
The funds are going to be used in our current business, expanding our procurement from small growers in Africa. We've quite extensive program across close to 30 countries in sub-Saharan Africa. And further, this fits quite well into our strategic investment into infrastructure, trying to own the whole value chain. So the timing of these funds quite well placed. Prospects in our markets are very favorable. So I don't think the money is going to stay long in our bank.
Mm-hmm. Okay, I mean, talk to us, about the competitive niche that you operate in when it comes to being able to work with small-scale farmers and being able to provide them with the scale that is needed to get their product to global markets. How does that all work?
You know, we often mention our linkage to small growers, and the group today buys about 85% of its African procurement directly from small farmers. And this is quite significant in the fact that the costs saved on our side and also the good market prices we can relate to small growers in Africa has boosted a lot of the agricultural economies the group's been operating over the last 45 years. Mm-hmm. And this, the fact that we can aggregate small tonnages from each individual farmer and eventually export quite large quantities of commodity, that's put us in quite a unique space and hard for competition, we think, going to be to follow.
From Standard Chartered's perspective, of course you've invested, according to the report, $600 million in African entrepreneurs and African startups. What are your thoughts on the assessment of the attractiveness of agribusiness right now, and how would you evaluate the risks?
Agribusiness, generally speaking, is not generally a private equity niche of investing in. What we believe where ETG is special is they're not really in primary farming, but they're further down the value chain, and they give you exposure to parts of the value chain that are more attractive and are closer to the consumer rather than primary farming.
Mm-hmm. So, of course, closer to the consumer. So to give us an idea of how you're going to extend your operations in Africa right now, with, of course, a growing middle class, growing demand for food, what's next? And how are you going to use the $100 million, as you say, not staying in the bank for too long?
Well, we tend to firstly, stick to our primary core competence, which is managing the value chain, the agricultural value chain. So we've got very strong linkages between Africa, India, Africa, China, and vice versa. And we tend to invest more in this, I think.
When you talk about investing more in that, just explain to us exactly what that means. Building more warehouses?
No, for sure. I mean, in terms of pushing up our volumes, we'll obviously have to invest in storage capacity. But one of our also core focuses is investing in agricultural processing, value add to commodities, which we've historically has been underinvested in our markets. A lot of the commodities historically have been processed in India and Europe. So we're trying to bring a lot of that home by then also creating jobs and also creating
beneficiation,
revenues.
basically.
Exactly.
In a sense. Talking about the markets that are looking at accessing the food that we create on the continent, who are the main producers, or who do you sell to? You talk about China, you talk about India. Is there just growing demand for the food that we produce on the continent?
Overall there's been a global shift, as very much in the news, of income increase for the poor. This has led to an increase in protein consumption, which drives starch. Our big demand markets have historically been India and China, and certainly these have just been picking up a lot over the last few years. We also export to Europe and America, but certainly China and India is taking up a lot of this volume.
Mm-hmm. And the last question I have is, obviously as a private equity player, you've talked about being committed for some time. At what point in time are you looking to exit the group?
The plan for export trading, as we said the first time around when we made our investment in Jan, our ultimate plan is to get this business listed on a global exchange. And the plan for that is, again, we're thinking in 2016, 2017, in that range. Mm-hmm. But the ultimate plan is to create a global company that's just happens to be based in Africa.
So the listing, talk to us, is Africa an applicable place, or do you think a developed world market would be better suited for the company?
It's tough to say. I think at the moment, if you look at where these type of businesses are listed, generally speaking, if you look at Olam, you look at Wilmar, at the moment they're generally in Singapore. So those type of investors understand the businesses. So if I were to say today, right now, which exchanges make sense, Singapore will probably be at the top of that list. You could probably say Hong Kong, but over time, a market like London, the LSE is probably feasible, and maybe at some time, maybe even the JSE.